This is Jumping In, the short form series of the Jedburgh Podcast. I'm the creator and host, Fran Racioppi. Each week I have the opportunity to speak with transformative leaders, visionaries, drivers of change, those dedicated to winning no matter the challenge. Our long form series has been an opportunity to go deep, unpack all aspects of our guest and their story. For Jumping In, just like our Jedburgh teams of World War II, I want to get on and off the drop zone fast. I want to catch up with previous guests, give my opinion on what's happening in the world, and uncover some of today's most pressing issues. The entire Jedburgh podcast is sponsored by Jersey Mike Subs. Together, we share the mission of giving back and building community together. A percentage of all proceeds is dedicated to the Green Beret Foundation, supporting America's special forces and their families. Sultan Meghji, welcome back to the Jedburgh Podcast. It hasn't even been that long since the last time you were on, and we don't have too many repeats.
Well, it's funny, wasn't it about a month ago? This is it's great to see you again, brother.
It was, absolutely. Thanks for joining me. You've been super busy over the last couple of days because absolutely almost everything we talked about when it comes to the integrity of the financial system and how important, not only how technology is important in the integrity, but also consumer sentiment, how people feel about the banking system, was everything we talked about in episode 91. We dug so far into all things tech. That was how we let it off. And here we are this week. We've seen two major banks collapse, one on the East Coast, one on the West Coast. And now, over the last 24 to 48 hours, a loss of confidence in one of the largest, most well-known banks in the world, being Credit Suisse. I need to ask you, what is going on? But first and foremost, we talked all about the FDIC. You were the chief innovation officer at the FDIC, the first one there. Now, all of a sudden, this organization that nobody knows anything about, nobody even cares about, is front and center because someone's got to protect the money. So let's talk about banks failure. Why do they fail? And how did we get here today?
So small topics. I'll cover this in about 30 seconds, right? So a couple of things. So first off, in the last pod, we talked about the deposit insurance fund and what that is. And one thing that I've tried to make a point of saying to everyone right now is, listen, don't worry about your checking account. It's fine. Just don't stress about it. Doesn't matter if it's got $1 in it or $1 billion in it. The U.S. government has said, backed by the full faith and credit of our nation, that it'll be protected. And we see that, right? And everything is calmed down. I know a couple of people who actually were Silicon Valley Bank customers a month ago and plan to be Silicon Valley Bank customers a month from now, or whatever form that entity takes. So that's the first one. The second thing to sort of talk about how we got there, I'm going to talk about two things. First is something we talked about on the podcast, which was kind of an issue with technology that so many banks and so many regulatory bodies have. They're just not very good at it, and they're kind of afraid of it. And all of the data that you needed to see that some of these issues were going to occur once the Fed started raising interest rates were there. And there are a lot of people who in November, December, and January, and even into early February, have made a fortune by shorting some of these stocks because they saw this coming. The second thing that's happened is going from quantitative easing to quantitative tightening in as short a time as we did, and in 2022 having the single largest increase in Federal Reserve interest rates in human history, has caused a tremendous imbalance in a subset of the banks in the United States. And it just so happens that a bunch of those banks are also ones that under the previous administration are not being examined as seriously as they were after 2008. And that list of banks is every single bank that's been in the news here in the US. We don't have a banking crisis. We have a psychological issue right now where a bunch of people are just convinced that their money isn't safe, and that's just not true. Their money is safe. Now, are there some banks that weren't managed as effectively and maybe weren't examined as effectively as they could have been? Absolutely, in both cases. But guess what? The free market is going to do what the free market is good at, which is wipe them out. And in the case where it's systemically important, the U.S. government's going to protect it. And then at the end of the day, probably make some money on the deal. This big loan package they put together is going to end up making the U.S. government some money, I think.
Well, I got a few follow-ups on that because you talked about the interest rate interest rate hikes. And is that what drives this? Is that what creates this problem? Because when we really break it down, you talked about consumer sentiment and people being afraid, but if you go back a week and we talk about what happened at Silicon Valley Bank, when all of a sudden, they make a report, they lost a few $1 billion, and now everybody says, give me my money. Why does that create the run, and how is that tied into the interest rate hikes? Because why is their money all of a sudden they're illiquid?
Well, let's just say that you're a bank, and a year or two ago, in the height of COVID, you borrowed, because every bank does this. They borrowed money from the federal government, and they borrowed it at, let's say they borrowed $100 million at 1%, which is, or 0%, let's say, or 0.25.
Great deal.
Yeah, it's a great deal. And it's why I think a lot of us wish that we could get the same deal the banks did, because, we'd all have, way better loans than we currently do, right? So let's just say you do that, and you borrow it at 1%, and then you take that money, and in the way of levering, you go off and you buy something that is generating, let's say, 3% return on investment, which at the time in a bond was kind of a reasonable number. Then all of a sudden, the interest rate on that loan goes from 1% to 4.5%, but you're still only getting 3%. You went from making 2% to losing 1.5%. Well, guess what? If you're doing that, and you're doing it in bonds, and you're doing it in mortgage-backed securities, and you're doing it in investments in tech startups that all of a sudden are worth less value, and you're highly concentrated in those areas, and those three, by the way, are exactly where Silicon Valley Bank was concentrated, you now are all of a sudden where instead of making, hundreds of millions of dollars a year, you're losing billions of dollars a year. And that's exactly what happened. It also did not hurt at all, or did not help, I should say, did not help at all, that they hired Goldman Sachs to do a fundraising round and maybe sell some bonds. And Goldman Sachs apparently messed it up pretty badly. And a bunch of bad news came out. And then Silicon Valley Bank went under, and then magically 3 days later, the U.S. government came up with a rescue package and activated the Deposit Insurance Fund for Signature Bank and for others. So, you can trace the balance sheet problems for Silicon Valley Bank directly back to the increase in Federal Reserve interest rate hikes.
So you mentioned the term mortgage-backed securities, and if we, we're all kind of have this, it's a triggering effect, I think, for so many when you hear that term. Yeah. But they do still exist after the 2008 financial crisis. But what you've seen is a different regulatory set of standards be put on sizes of banks, right? And so we talk about the Bank of America, the JP Morgan Chases of the world. They sit above this threshold where they're very limited in what they're allowed to do in that world. Yet these smaller banks are still very much invested in these types of activities.
Oh, absolutely they are. And it's important in as much as we remember the phrase mortgage-backed securities and all get, hives thinking about it. There's another phrase called subprime borrowers. And that's, that was really one of the triggering events of 2008. Here, it's not that, although we are going to start seeing, we're seeing housing prices go down, et cetera, et cetera. Subprime is actually probably going to come back to bite us in a quarter or two on the car loan side of the house. But I think that's a crisis for 6 months from now, 3 to 6 months from now. And you'll have to have someone else come on to talk about that. But that's not my world. But no, mortgage-backed securities are, and historically have been, and will continue to be, generally speaking, a reasonable investment. But when you consider COVID, when you consider all of these extenuating circumstances, we are in this kind of intriguingly, annoying, frankly, perfect storm that has caused, a bunch of organizations to now all of a sudden have far weaker balance sheets than they realized. And Credit Suisse is a perfect example of that.
Kevin, it's a new year for 18 Alpha Fitness. We've talked for so long about building elite performers.
So as you can see, we have developed and expanded 18 Alpha Fitness.
So everybody who's getting ready to become a special operator, go to selection for whether it's going to be a Green Beret, Navy SEAL, you want to become an Army Ranger, you want to join the Air Force, become a pararescueman, right? They can come to you, hop on 18 Alpha Fitness app, and you're going to take them through some very specific workouts that are designed for each one of those training programs.
We're going to start off with just 12 regular push-ups. Spider-Man push-ups. So on a down position, your left knee comes to your left elbow. Right knee comes to your right elbow. Next one is diamonds, everybody's favorite.
You want to take it to the next level. You want to be one of America's best. get on 18 Alpha Fitness. Check it out.
So on the Credit Suisse situation, you haven't seen what we've seen with Silicon Valley Bank and with Signature over the last couple of days. But what you saw was much more the consumer sentiment, and then the Swiss government coming in and saying, hey, we're not going to let this thing fail. How's that different than what's happening right now with Silicon Valley Bank, Sovereign Bank?
Oh, I mean,
Signature,
there's a lot to decompose there. First off, Credit Suisse has been kind of a problem child for a long time. Of that category of bank, they've always been kind of the stepchild who's always been kind of run a little bit worse. Having a little worse balance sheet, et cetera, et cetera.
Didn't they stop trading equities a couple of years ago too?
Yeah, totally. I mean, it's just like every couple of years there's something with Credit Suisse, right? And so when you have this kind of market compression in the banking sector, and to a degree, a regulatory system, especially here in the United States, that pushes on organizations that are at the fringe, let's say, it's not hard for an organization like hard for an organization like Credit Suisse to get kind of stuck out at the edge when the sentiment gets bad. And if you're, if I'm at Credit Suisse, I'm nervous a little bit, although the Swiss did step in with this 50 billion franc credit facility. But at the end of the day, it's, Credit Suisse has just been a problem for a long time. And so I think a number of the central banks and the regulatory community are going to use this as an opportunity to just get some of the problem kids out of the system. And I think it's time for Credit Suisse to move on.
Let's go back to the FDIC for a second, because you talked about the fact that they've come in, they effectively take control of the bank, and they protect you by law up to $250,000 per account. But what we've seen is all these stories, especially in the first couple of days. Companies aren't going to make payroll. All of a sudden, you have at most $250,000 on your balance sheet. Everything else is gone. That's not really the case, though. Can you talk about what is actually the situation for people, for their money, when this situation occurs in the bank? Is their money really gone?
Actually, the funny thing is it's not. They just turned off the computer. That's really all that happens. So, the thing to remember is if you're in one of the money center banks, one of these top 5, we call them GSIBs, globally systemically important banks, JP Morgan, et cetera. Your money is fully protected ever since the phrase "too big to fail" happened. Mm-hmm. Right. So that's it. You're fine.
In totality, all your money.
All of it, yeah, all your deposits, not your stock investments or anything like that. But like you put cash in a checking account, you're good. That has not been true for the whole rest of the banking system since 2008. It's been that $250,000 FDIC number that we all know and love. What happened on Sunday was the U.S. government said we are going to treat all the banks like we treat the big boys, just to avoid people freaking out. And for those banks that were shut down or went under in the weeks leading up to that, whether it's Signature, which got closed on Sunday, or Silicon Valley Bank, or potentially any of these others that people are worried about, it doesn't matter. Your money's fine. You just might not be able to get to it that day. And with Silicon Valley Bank in particular, what ended up happening was when the U.S. government took it over, it just took them a few days to reboot the computer, is fundamentally what happened. The minute the U.S. government took that over, whatever dollar amount was in your bank account 5 seconds before that is what would be there when you got access to it. Now, in the case of both Signature and Silicon Valley Bank, it took more than 5 minutes to get everything rebooted so people could start moving money. Within the orbit I live in, I mean, it took, I think, so today's Thursday. It took until Wednesday for an outbound wire from Signature to get from company A to company B in a different bank that I was observing. And on Monday morning, I saw wires leaving Silicon Valley Bank if people wanted to. Now, a bunch of those people are moving their money back, but it's just there. It takes a day or two to get access to it. I think a lot of the stories about people not making payroll and freaking out and all this was a little bit of hyperbole in the media, but then also a bunch of operational managers of companies who didn't understand, kind of how the world works and had a single bank account with millions of dollars in it instead of having, a couple of bank accounts at a couple of different institutions that kind of live in different places. I'll just say, by the way, whether it's, personal finance or corporate finance, I always tell people you should have money in one of the big systemically important banks, you should have money in a credit union, and you should have money in a mid-sized regional or community bank. You should always split your deposits 3 ways, because there's no way that all 3 of those are going to be unavailable at the same time.
That's good. That's good advice.
Because even if it's just $5, it's a heck of a lot easier to move money from point A to point B than it is to open a bank account when everyone else is trying to open a bank account.
Yeah, you're right. You're absolutely right. You have it there when you talk about preparation. There's your preparation for financial crisis.
We all have go bags, right? We all have all these things that we've picked up in our lives to that we have to do to figure out how to respond to crisis, whether it's a go bag or water in the basement or a generator or whatever. There's the same thing financially. You want to keep some cash. You want to keep, clean credit cards. You want to have money in different bank accounts. You probably want to have some crypto in there too. There are a bunch of different things you should do, even if it's nominal amounts of money, a couple $100s, just to make sure that at any one moment, okay, I need to, put gas in the car, or I need to go to the grocery store or whatever. I don't have to worry about some third party, being operating in order for me to do what I need to do.
One of the biggest challenges we have in building great organizations is accurately identifying the strengths and weaknesses of our team and our teammates. Compass Workforce Solutions is a certified predictive index partner. Since 1955, the Predictive Index Behavioral Assessment has objectively provided insight into employees' workplace behaviors. This allows us as leaders to predict what drives and motivates others, helps us to be better managers, and enables more effective communication to increase performance by really understanding who's on our team and what they do best. I've incorporated Predictive Index, Compass, and Christine Ippolito's team into every one of my businesses and my performance development programs. Incorporate science-backed behavioral assessment tools like Predictive Index into your organization today and see how quickly you reach your goals. Learn more about Compass and the Predictive Index Behavioral Assessment at compasswfs.com. Are taxpayers paying that bill, though? Because now everybody's saying, the taxpayers are paying the bill of the bank. Is that really happening?
No, not at all. Think about it like this. Half of the money being used to stabilize the banking system comes from the Deposit Insurance Fund, which is a insurance fund, the FDIC, Federal Deposit Insurance Corporation. It is both a federal agency and a private company. It is an insurance company, and that fund is funded by premiums from the banks. That does not come from taxpayers. It comes from the banks. It's part of the privilege they get to pay by operating in the best banking system in the world. The other half of that money is basically a loan from the Central Bank of the United States that they will make money on. That comes from everything from tax revenue to, revenue from agencies. We always lose sight of the fact that the U.S. government actually is a profit-generating business, if you think about it that way. And it's one of the reasons why we can carry the debt load we currently do, is because our GDP fundamentally is a very large company that makes money. But no, as of today, there is no taxpayer dollar being spent that I wouldn't spend myself, or say there's a good use of our government's money, because they'll make money on this, just like they made a lot of money out of TARP.
Yeah. What would cause a run on the banking system and a systemic collapse at this point?
Runs on banks are psychological. They're not based, especially because of how we've structured the banking system, what you and I have been talking about for the last few minutes. There is no structural issue, okay, with the banking system. It is simply psychological. People are nervous. They feel better when their bank isn't the one in the news, right?
I went on the payroll provider for my company the other day, and it said, you will make, it literally said, like, you will make payroll. You are not affected by this. Yep. Your bank is not affected by this.
Yeah. I mean, this is the kind of stuff. It's all psychological, right? And it's in direct conflict with, a bunch of us are just trying to calm people down and say, listen, you don't need to stress. Yeah. Like, just relax, go to bed, hang out with your kids, watch TV, whatever you do on a Sunday night, do that, right? And a bunch of people who want to get viewers, who want to get clicks. The impact of Twitter and social media on this conversation has been extraordinary. To watch, the gossip and the rumor and the frenzy that gets created, because they make money when that happens, right? We're all clicking on our social media feeds. Oh my gosh, what's the latest thing? What's the latest thing, right? And for the most part, it's utter noise in the system. I tend to ignore social media as much as possible for that kind of stuff. And I would suggest everyone else here does as well.
Well, we're here to dispel the rumors. So it's all about finding the truth, right? Finding the facts, and that's what we're seeking to do all the time on the Jedburgh podcast. So I guess what you're saying is taking me to my last question. I don't need to follow the Fox News during the daytime because the gold commercials are up 40% throughout the day, and now I have it in my mind. Do I need to go buy gold right now?
Yeah, I don't think either you or I are that demographic. We both have a little bit too much connection to reality. Yeah, I don't want to call out any one media organization or any one investment hypothesis, but I would not take what someone is paying to put in front of me on daytime TV as a meaningful investment discussion. But no, it's literally the only thing that I would ever worry about, and I'll be completely real here. The only thing I would ever worry about that would actually make me stress out about the money in my bank is if somehow the U.S. defaulted on either the debt ceiling and then defaulted on our debts, or defaulted on something at that level that caused the value of the dollar to decrease significantly. That is literally the only thing. And so, there's this whole parallel conversation going on about making sure the debt ceiling gets raised. I hate the fact that it's as high as it is. Like, it bothers me. It's too high. It's still lower than a lot of other countries, but it's still too high for me. But the fact is we have to service that, and that has to be legally binding. And if we ever get downgraded, if our credit worthiness ever gets downgraded significantly because we defaulted, that causes me to stress out. And that would absolutely cause me to question whether or not holding US dollars is a good idea.
Fueling our bodies for peak performance is one of the most important parts of our preparation. It's also one of our most difficult choices. We live in a world full of options like energy drinks, shots, gels, and snacks. Mod Balls is the natural choice. Just a 20-gram Mod Ball packs 10 times more energy per gram than the other options, and they're safe for active kids, adults, and athletes. Macronutrients from 75 fruits, veggies, seeds, nuts, chocolate, and raw honey replace caffeine and sugar, increasing energy without creating a jittery stimulant buzz or sugar crash. Plus, Mod Balls are only 100 calories. They're individually wrapped, organic, vegan, dairy-free, soy-free, gluten-free, HFCS-free, and GMO-free. They're also $10 off your first order when you use code JED, J-E-D, at modballs.com. All right, so the guidance for everybody is calm down. We're not in a crisis. Let's put our thinking hat on, understand the situation. That's what we're trying to do. Sultan, you're front and center this week in such a meaningful conversation. I will tell you that after our episode 91 deep dive into so many of these issues, I had people reach out to me and tell me that our conversation out of almost 100 episodes, over 100 episodes of the Jedburgh podcast, was the most important topic that we've discussed to date. So thanks for joining me then. Thanks for joining me now, bringing some clarity and some reason to some chaotic times, because I always say soldiers and people, they care about their time and they care about their money. You mess with either one of those, it gets everybody up in a frenzy. Now we got some guidance.
Yeah. It was great to be back on. Thanks so much for doing this. This is still my favorite podcast. It's what I listen to every weekend. And man, it's just good to see it. It's good to see it. I'm sad we're not doing it at the dining room table this time.
Well, next time.
Yeah.
Thanks so much. American Jedburghs went out to form the foundation of the United States Special Forces and the Special Activities Director to the Central Intelligence Agency. Thanks for listening to the Jedburgh Podcast. I'm your creator and host, Fran Racioppi. Join us next week for a new episode on Apple, Spotify, or wherever you get your podcast. Check us out on YouTube for full episodes, highlights, and other behind-the-scenes content. If you like what you heard, give us a like and leave a review. Follow me, Fran Racioppi, Talent War Group, and our sponsor Jersey Mike Subs on LinkedIn, Instagram, Facebook, or Twitter. Send your comments and inquiries to media@talentwargroup.com. As a former member of Special Forces, the Jedburgh Podcast donates a percentage of all proceeds to the Green Beret Foundation, supporting America's Special Forces and their families. Thanks for joining us on this episode. How you prepare today determines success tomorrow.